Hi everyone, welcome to another video by Optionables. My name is Saket and in this video we'll be covering how to read open interest data using Sensibull. So we have been getting this request from quite a while to cover or make a video on Sensibull. So today we thought, since the market is also volatile, it would be a great time to cover different aspects of open interest, how we can use open interest data in our positional as well as intraday trades. So before moving on to the video, there are a couple of more things which I would like to tell you. The first thing is that in the description below, there is a link to Sensibull. So if you actually end up purchasing Sensibull using Optionables referral, you will be getting close to 50% off on the annual subscription plan. So if you like the platform, you can definitely purchase it. And the second thing is regarding the 100 free orders with opening an account with Firstock. So if you are planning to shift a broker or looking for a new broker, you can definitely consider Firstock. So they have a pretty advanced platform. So if you open the account, you will be getting your first 100 orders absolutely for free. So with that, we'll be quickly moving on to the video. If you're liking the content on this channel, then please do hit the like button, share this video as well as subscribe to Optionables. Thank you so much for joining. Hi guys, welcome to another video by Optionables. So in this video, we are going to cover basics of open interest and we are going to look at various aspects, and we can also see how we can use this open interest data in our daily trading as well. So I'm also going to show how to read open interest data, what we get from Sensibull, and how we can make the best use out of it. So first, before moving on, we have to understand regarding the participants in the market. So who are the participants in the market? So 1, we have retailers. 2, we have institutions. So all of us know this. And now I have a question to you guys. Who do you think make money in the longer run? So do you think retailers make money in the longer run or the institutions make money in the longer run? So it is a known fact for us that usually 95% of retailers end up losing money, right? So if retailers are losing money, then who must be making money? There are only 2 participants in the market. If one participant is losing money, since trading is a zero-sum game, so the other participant, that is the institutions. So these institutions will end up actually making money. So historical data already suggests that institutions always end up making money and retailers most likely will end up losing money. So whatever trades we take, we have to always look from the point of view of the institution. So what exactly is institution doing? Are they buying or are they selling? Because you want to be on the side where people are making money. So you want to follow them so that even you will end up making money, right? So that's why always think in the lines of the institution. Why exactly are they doing something? Why exactly are they entering a particular position? So that is the question that we have to ask. So since we are pretty clear about this, about retailers and institutions, so now whatever we discuss, we will only discuss it from the point of view of institutions. So we will not consider retailers. So we will only discuss from the point of view of institution. So now I will just show you Nifty option chain. So here you can see a column called as open interest, right? So you have a lot of data here and lot of data on the put side as well. So what exactly are these open interest? So for example, here I can see a number of 1,44,000 contracts. So what exactly does that mean? So this basically means that there is 1.4 lakh lots. So 1.4 lakh lots which have been in open position. That means there is 1.4 lakh lots of long quantity which is at open and 1.4 lakh short quantity which is still open and yet to be closed. So these things are not yet closed, they are yet to be closed, but these many long contracts are open, short contracts are open. That means people have carried the position. So we will look at this from the point of view of institution, right? So let's say institutions are actually the sellers. So we'll just keep an assumption that institutions are actually the sellers, right? So why would an institution sell 1.4 lakh worth of particular contract? Why would they sell 1.4 lakh worth lots of 18,000 CE? Does it make any sense to you? Yes, only if they are not expecting the market to go above 18,000, because they are selling 18,000 calls at 40 rupees expecting the market to stay below 18,000. If the market is actually going above 18,000, they won't sell calls. So they're only selling because they are expecting the market to stay below 18,000 for this expiry. And institutions, always remember, is the smart money. So what they are doing generally affects the market in the larger way because they have more money than the retailers put together, right? So when they are selling so many call option contracts, that means the market is most likely not going to go above 18,000, because if the market actually goes above 18,000, then these call options will actually start to gain. Let's say the expiry happens at 18,200, then they will actually end at 200 rupees. And institutions don't want to take this huge loss of 160 rupees. They hardly want to take such a huge loss, right? So from the point of view of the seller, assuming that institution is a seller, if they are selling a lot of call option, that means the sentiment in the market is bearish. So this is to be extremely clear that if there is a lot of call options and institutions are seller, the sentiment in the market is bearish. So now you might ask, Saket, why can't institution be buyers? What is the problem in institutions being a buyer? So let us assume institutions have bought this time. So this is +1. So institutions are buyers. Okay. So they have bought 1.4 lakh lots of 18,000 CE. One thing what we have to note here is that institutions are not here to gamble, right? So they are not going to purchase a call option at 40 rupees planning to give this at 200 rupees. That is not their aim. So if institutions are buying call option, then they will be buying it as a hedge. So only to hedge, they will be buying a particular call option. So why would you hedge a particular thing with the call option? So you would only hedge it with the call option if you're short on futures. So only if you have shorted futures, you will actually end up hedging it with buying a call option. So now again, assuming that institutions are buyers, so what does it technically mean? That they have shorted futures, right? And their outlook on the market is still going to be bearish, because you don't short futures if you have a bullish outlook on the market. You will only short futures if you have a bearish outlook on the market. So overall, doesn't matter how you look at it. If you look at this from the point of view of institutions as sellers, then also the market is bearish. If you look at institutions from the point of view of the buyer, then also the market is bearish, right? So what you have to understand from this is, if there is a huge call open interest, that means the higher the call open interest, then the more bearish the market. So this is extremely important for us to understand. If the call open interest is very high, then the market is more bearish. So why we actually understood, if institutions are sellers of the call option, then the general expectation is that the market won't go above that particular level. If they're buying call option, they will be buying it as a hedge, not as a gamble. Why would they actually buy a hedge? So the simple concept is that they will be either short on equities or short on futures. So only if they have a short position, they will buy a hedge. And the moment they are short on futures, you know that the sentiment in the market is bearish. So higher call open interest means the sentiment in the market is bearish. So always remember that. So similarly, if the put OI is very high, then the market is usually bullish. So again, the explanation to this is pretty simple. Why would the market be bullish if the put OI is very high? We'll quickly look at it from the point of view of institutions again. So institutions will sell a put option if they expect market not to come down. So they will buy a put option if they are long on futures. So they are long on futures, which means they are by default bullish on market, and they are hedging their exposure with a put option, buying a put option. So no matter in which angle you look at it, unless an institution is actually trying to sit and gamble, they are going to tell, okay, I am going to buy this particular option at 50 rupees and I am going to sell it after it goes to 200 rupees. You don't find 99% of the institutions don't do this. They are not here to buy option and sell the option at higher rate. So they are here to make bigger money than this. So that's the reason we have to think from their perspective. So we understood two things. Call OI very high is bearish. Put OI very high is bullish. Right? So now coming back to the option chain right over here. Right? So if I actually scroll down, you can see the total open interest. So totally on the call side, there is 13 lakh OI, and on the put side, there is 6.5 lakh OI. So now we already understood one thing. Higher call OI means bearish, higher put OI means bullish, right? So now looking at these two, you only tell me what is the sentiment in the market. You can pause the video and try to go back and see that again. So what is the sentiment in the market? The answer is pretty easy. It is definitely bearish. Why bearish? That is because there are lot many call contracts compared to put contracts. So this simple thing will suggest us that the market is more bearish than bullish because there is more amount of call writing happening. So before we move on, right? So we always look at open interest from the seller's perspective. So we never look at open interest from the buyer's perspective. We most likely always look at it from the seller's perspective. So why do we actually look at it from the seller's perspective? So I'm going to explain this before we actually go to Sensibull, right? So now let's look at 18,500 call option. So this has a total of close to 90,000 open interest. 87,000, we'll just round it off to 90,000 as our open interest, right? And it is trading at a price of close to 6 rupees. So 6.25, just for simplification of calculation, we'll just keep it as 6 rupees. I'll just make a quick note of this. So we are always looking at open interest from the perspective of seller. Now we are looking at 18,500 call option. This is currently having an OI of 90,000 lots. So when I say 90,000 lots, it is close to 45 lakh quantity. So why 45 lakh quantity? It is pretty simple. Each lot size is 50 quantity. So when I multiply 90,000 lots into 50, so we have total of 45 lakh quantity open. So there is 45 lakh quantity of options which have been bought and still open, and 45,000 quantity of call options which have been sold and still open. Now let us understand this particular thing, right? So let's say each of these options is trading at 6 rupees. We already saw that. For a buyer to enter one lot of this particular contract, how much does he require? 6 rupees into 50. He just requires 300 rupees, right? So let's say all the buyers put together, how much they have totally paid. So each buyer to enter one lot, he just requires 300 rupees. All the buyers cumulative have paid 45 lakh into 6 rupees, which is just going to be around 2.7 crores. So they have just paid around 2.7 crores, all the buyers put together. Now we will look at this from the seller's perspective, right? So the buyer only has to pay 300 rupees per lot. But how much money should the seller bring in? So I'm using Firstock margin calculator here. So to sell 18,500 call option, one lot, a seller requires close to 75,000 rupees. The buyer only requires 300 rupees, whereas the seller requires 75,000 rupees. So now you might argue, Saket, no one is going to do naked selling. The era of naked selling is gone. So everybody is going to purchase a hedge. Okay, so let us add some hedge. Let's say I will buy 18,700 call option as hedge. In spite of that, he requires somewhere close to 26,000 rupees to sell one lot of 18,500 call option. So after buying the hedge, so without buying the hedge, it is 3 times more. After buying the hedge, he requires close to 26,000 rupees per lot. So that means how much have totally the sellers paid to enter this contract? So the buyers all put together have paid around 2.7 crores, whereas sellers have paid somewhere close to 234 crores just to enter this contract with the hedge. So I am always including a hedge. So if we remove the hedge, they have paid somewhere close to 700 crores. So now there is a huge difference between a buyer as well as a seller. So all buyers put together only pay 2.7 crores, whereas all sellers put together pay 100 times more. Or if you see per lot, a buyer only requires 300 rupees to enter, whereas the seller requires 26,000 rupees to enter after hedging the position. So now you tell me, who should have the higher advantage? If buyer is given an advantage in option trading, then obviously there will be nobody who is willing to spend so much money to sell an option. So let's say I buy at 300, you put 26,000 and sell an option. And let's say I have higher chances of making money. Why would you even sell? Are sellers out of their mind to sell something paying 26,000 rupees if the buyer has higher chance of making money paying 300 rupees, right? So always question this yourself. So would you pay 26,000 rupees to have lesser chance of making money than a buyer who is just paying 300 rupees? Obviously the answer is no. You must be having the highest chance of making money. That's why you're paying more money than the buyer. So that's why when you look at this, the seller has more at stake. The seller has risked more. So that's the reason sellers are always given an edge in option selling, because he has to put in more capital to actually do option selling. For the same reason again, even open interest is always looked from the perspective of seller, not from the buyer. So this is one thing that you have to be very clear before you actually read the open interest data. So now we will actually go to Sensibull and try to understand what exactly the data suggests. So this is the OI data in Sensibull. So this is the inter-day OI change. So that means from yesterday to today, what have people actually done? So have they entered more call contracts or have they entered more put contracts? This is from yesterday's closing till today closing. So that is very important to understand. So today you can see that people have totally entered, or OI on the call side has changed by 28 million or 2.8 crore contracts, right? So what does it mean? 2.8 crore contracts of OI on the call side means people are expecting the market to be bearish. So what about put side? Put side, only 11 million has been added, which is 1.1 crore. So which has more contracts now? The call side has more contracts, right? So if call side has more open interest contracts, what does it mean? It means the sentiment in the market is bearish, right? So this is very important for us to understand. The sentiment in the market is bearish because there are more number of calls added compared to puts. This 28 million is fine, but if puts was 50 million, right, then obviously people are expecting the market to bottom out and the market might head higher, because you don't add so many put contracts unless you're actually sure that the market is going to be bullish. So now we saw this, right? So where exactly are people adding lot of contracts? So out of this 28 million, where exactly have they added so many call contracts? So when we actually look at this, we see that people are actually adding so many contracts at 18,000. So 18,000 call option, many people are adding. So there is a huge open interest buildup happening at 18,000 call option. So now from the perspective of the seller, always we are looking at from the perspective of the seller. Why would a seller sell 18,000 call option? So we already discussed why exactly we are looking at from the perspective of the seller. The answer to this is pretty simple. That is because the seller is not expecting the market to go above 18,000. This is the simplest explanation what you can give. So he is not expecting the market to go above 18,000. He sees some resistance coming in at 18,000. That's the reason he is selling so many call contracts. And there is some strong call writing happening at 17,800 as well. And the explanation to this is again pretty simple. The sellers are expecting some resistance to come in at 17,800. So now this is what happened today. But what is the overall picture? How has it changed? So when we look at the overall picture, we see a lot of call contracts compared to put contracts. So 64 million calls compared to 30 million puts. Now again, I don't have to tell you much. What do you think the sentiment is? Definitely the sentiment is bearish, because people are expecting the market to come down, and that's the reason they are entering a lot of call shorts or they're hedging with call buy. So next, there is one more thing which I would like to show you, and you can see there is some unwinding of puts right over here. So you can see the quantity has actually decreased. So now again, why would you close a put option if you are a seller? So if the put option is being closed, so what does it mean? So in the first place, why would you sell a put option? So why would I sell 17,500 put option? So I would only sell 17,500 put option if I am expecting the market to end above 17,500. So if I am expecting the market to go below 17,500, will I close my put option? The answer is no. So what does it actually mean if people are withdrawing from 18,100 put option? What does it actually mean if people are withdrawing from 18,200 put option? That means for this expiry, they are not expecting the market to come above 18,200. So this is one really important thing what we have to understand. So this is the whole data as to how you can read, and as I told you, this is just the basics video. So what we covered today is basics of OI. So we understood the participants. We discussed about the participants in the market, retailers as well as institution. Second one, we also discussed on whose side we should always think. It is always on the side of institution. So this is just a summary of what we have discussed. Second, we discussed what does huge OI mean. So if the OI is very high, what does it mean? So if there's high OI on call side, it means the market is bearish. If there is high OI on put side, it means the market is bullish. So we also discussed why exactly this is the reason. And third, we discussed more about why we should look at OI from seller's perspective. So here we mainly discussed about margin and who actually brings in so much margin. So what we saw here is the buyer only required somewhere close to 2 crore, the seller required around 200 crores, and we know for a fact that so big money is with the institution. So if someone is selling option for 200 crores, it has to be the institutions. So these things have been covered in this particular video, and we also saw how visually we can try to understand the OI data using Sensibull, and we have lot of aspects to cover in open interest. And the more we go on, the video is going to get much lengthier and much complicated. So what I will do is that I will just wrap it up here as the part 1 of open interest. So in the coming week, I will also come out with part 2 of open interest, where we will try to dig in and understand these concepts much better. So we will see how dynamic open interest is and how does it change along with the market, and what exactly can we do using the data. We have so much more to cover, so that I'll be doing in the part 2 of this video. So I wanted to cover everything in the same video. Later I thought this might actually be little lengthier and it wouldn't be proper to fit in everything in one video. Right? So with this, we also come to the end of this video, guys. And if you're liking the content on this channel, then please do take out some time to hit the like button, share this video, as well as subscribe to Optionables. Thank you so much for joining, and I hope that you guys have enjoyed this particular video. Thank you.